Federal Reserve Chairman Jerome Powell spoke today at Jackson Hole during their annual retreat, which, by the way, so nice for them that they get this nice annual retreat up in Jackson Hole, Wyoming every single year, despite the economic hardships that other Americans are going through. Good for them. Now, he gave a speech that gave strong indications of the near future of monetary policy. And if we look directly at what he said and read a little bit in between the lines, we can see clearly what they plan to do: bankrupting households and crashing the markets. Ready? Let's dive in. We're going to look at 10 different things that Powell said today in this press conference that give clear indications of the near future of monetary policy. The first one here is that he said restoring price stability will likely require maintaining a restrictive policy stance for some time. So right here, he is indicating that they are not planning on raising and then easing very quickly here. The market was starting to price in a high likelihood of easing starting next year. And he's trying to push back on that expectation, saying, hey, we're going to raise interest rates. We're going to keep them high for a while. We don't see any reasoning right now that we're going to be able to stop that anytime soon. Follow-up comment there was that the historical record cautions strongly against prematurely loosening policy. And what he's hinting out there is the risk of tipping over into hyperinflation, because if they start to ease at the first sign of trouble here, well, we already have the forces in play to cause inflation. And so if at the first sign of hardship, they start to ease again, well, that will only add fuel to the fire of inflation, which could very easily tip things over into hyperinflation. And despite the fact that they're not very good economic historians, they are nonetheless economic historians, and they know that hyperinflation does happen sometimes in some places, and being too easy too fast is the cause of that happening everywhere all the time. So he's saying, look, even if we have some hardship here, we're going to maintain tightening because we don't want to err on the side of easiness when we're already experiencing inflation, because that puts us at risk of hyperinflation. Next, number 3, he said restoring inflation to the 2% target is the central bank's overarching focus right now, even though consumers and businesses will feel economic pain. Now, this is where we have to read a little bit in between the lines here, because causing consumers and businesses economic pain is the only way to bring down that inflation. Inflation is persisting because there's more money being spent right now maintaining those high prices of everything that people are buying. So the only way to bring inflation down is to stop prices from going up, which would mean stopping the demand from keeping prices going up. And the only way to stop that demand from increasing is to cause economic pain on households so that they stop spending as much money, so they have to pull back, and that as a result will cause economic pain for businesses as well. Given the fact that this is done through higher interest rates, this means squeezing people who have high amounts of debt, making that debt hard to pay off, causing in many places, bankruptcies for people who just can't pay their debt anymore. Also, translating over to business pain, that means a stock market crash as earnings are compressed. Number 4, he said an unusually large increase in the benchmark lending rate could be appropriate, even though he didn't commit to one. But this is another sign here that the market should be paying attention to, and is indeed paying attention to if we look at what the markets are doing right now. We can see the dollar is moving strongly higher as a result of today's speech. We can see that yields on the 2-year and the 10-year are both moving up, while the 20 and the 30 are moving down in expectation of economic weakness and the Fed continuing to tighten in the short term. This has led to massive sell-offs today in the S&P 500 being down 3%, the NASDAQ being down 3.5%, Bitcoin's down 4%, and the Russell 2000 over 3% as well, in addition to the precious metals, silver and gold, down a little under 2% and a little over 1% respectively. He continued this with very strong language. Coming in at number 5, he said that restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Again, this is what I alluded to earlier. They are trying to cause demand destruction because there's enough money that has flooded through the economy to keep demand increasing, especially on the key areas that prices have been going up a lot in, like food and energy and housing. And so he's trying to get demand destruction to take place, which you can only do by taking income away from households. And when you take income away from households, and you do that by causing their debt service costs to go up, so more of their income is diverted to paying off their debt, or you do it by reducing the jobs available, giving people pay cuts, things like that, that means that prices will then come down. You also result in earnings getting squeezed for companies, so you get economic pain for individuals and households, as well as companies, corporations, businesses, and this is how you bring into balance that demand and supply. He became even more explicit with how this is done with statement number 6 here that we're going to look at, that restoring price stability will require a sustained period of below trend growth and a weaker labor market. So we've already had 2 quarters of below trend growth because it hasn't been growth, it's been a decline. And so we've had below trend growth for 2 quarters now, and he's not even saying that that matters at all. He's saying we need a sustained period of below trend growth. So a recession that could last a year, 2 years, 3 years, who knows? And in the last part of that sentence, a weaker labor market, meaning that he needs jobs to go away. Right now, they are still seeing a lot of job openings, and he's saying this is contributing to growing incomes, that wage price spiral as incomes go up on average. That means people can still afford to pay the higher prices for stuff. And so to the extent that there are jobs open, that means that we still have pressure pushing wages up because people can keep on switching jobs and get better and better pay. He's saying we need a weaker labor market, no jobs available, people competing for job positions, very few jobs open. We want people to need jobs here. They want an entire country of slaves because that will help them maintain control. He followed this up with number 7 here. While higher interest rates, slower growth, softer labor market conditions will bring down inflation, they'll also bring some pain to households and businesses. Again, it's shocking the number of times in this speech that he's blatantly outright said we're trying to destroy demand in order to bring prices down. And the way we're going to do that is make the pain for households and companies so much so that they literally just cannot afford to continue to buy these things at these high prices. And in case you're still sitting there thinking, yeah, but the Fed always eases, they always bail out the market, they always rush in to save things when times get tough. Let's think about this for a second, because the pre-COVID times when this happened, we had no inflation. I mean, there was inflation, but the official numbers were right where policymakers wanted them. They were in between 0 and 2%. Now, you can argue they were higher than that, but that doesn't matter because the numbers they're looking at, they were saying, hey, there's no inflation here. So we have the capacity to bail out the market because none of our printing so far has caused any inflation. That's the difference between today and 5 years ago, 10 years ago, 15 years ago, 20 years ago. That's the difference. They're looking at inflation now. We have inflation printing on the numbers, and look at what they're saying here. This is number 10. While the lower inflation readings for July are welcome, a single month's improvement falls far short of what the committee will need to see before we are confident that inflation is moving down. So they're not just looking at July's numbers and saying, hey, month over month inflation on average was 0%. So we've done our job. For anybody who's waiting for the next bailout saying, hey, they're going to come in, they're going to bail the markets out here, they're going to ease again, not so fast. Everything they're saying is that they're going to take a while. They're going to keep on hiking and they're going to maintain those tight conditions for a while, even during a lot of economic pain for households and for businesses. They understand they're going to cause a recession here. They understand there's no soft landing. They understand it's going to cause some major economic pain. They don't care. They're signaling that very strongly here, that no matter what, even if month over month inflation comes down, like he said right here, while those signs are welcome, a single month's improvement falls far short. Not a little bit short, far short. They're going to want to see the inflation numbers sustained for a while at the place that they want them to be at. Otherwise, they risk easing too soon. Since the start of 2020, the Federal Reserve has signaled far ahead of time exactly what they've planned to do, and they've done it. So for the entire year of 2020, they said, we're going to keep on being easy. We're going to keep rates low. We're going to print money as much as Congress needs in order to finance their fiscal policy, their spending. And they did it. And they said, we're not thinking about raising rates. And they weren't, and they didn't. And then finally, they started saying, we're going to start tightening at some point soon. And then when it got closer and closer, then they finally did it. Now they're tightening. And now what they're telling us is it's going to be a while before they get easy. They're going to stay hard. They're going to stay tight no matter what, even if there's economic pain. So when somebody shows you that they are going to do something over and over and over again, and then they do it, believe them. We've got some hard economic times coming up. We've got some economic pain. People are going to start losing, well, a lot of people are already losing their jobs because their job indicators are lagging and they don't see all of the layoffs that are starting right now in a bunch of industries, especially like tech. But they are going to cause economic pain. They want to see jobs lost. They want to see businesses go under. They want to see bankruptcies because these things lead to income drops, leading to demand destruction, which will bring prices back in line with where they want to see them. They don't care about your economic pain. A bailout is not coming, at least not yet. And if you would like to understand how to bulletproof your portfolio and invest in a way where you are not vulnerable to crazy crashes, to deflationary times, hyperinflationary times, regardless of what the market can throw at you, anything that the market can throw at you, you know that your investment portfolio will survive. Check out my portfolio allocation mastery course linked in the description below. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.